Compare what hit your bank account last payday to what you actually earned before deductions. Between income tax, national insurance, and student loans, that gap is wider than you think. For earners between £50,000 and £100,000, mandatory deductions consume every penny you earn from New Year's Day through the end of May. This is the result of a system built to target salaried income. The government has designed the rules so that labor is the most heavily taxed activity in the country. But there is a quieter mechanism at work that doesn't require a single new law to increase your bill. It's called fiscal drag. Since 2021, the government has kept tax thresholds frozen while inflation pushes wages up. This chart shows the result. As your pay increases to keep up with the cost of living, you are pushed into a higher bracket. By 2028, this silent shift is expected to pull 4 million more people into paying higher rates. Even if your spending power stays the same, you are paying a larger percentage of your life to the state. The system is deliberately squeezing the standard salary. Let's track a single pound earned through labor. Before it even reaches your pocket, income tax and national insurance take 40 to 50% of it, leaving you with roughly 60 pence. When you spend that money, you're taxed again. VAT takes 20% of most purchases, leaving your 60 pence with the buying power of 48 pence. If you buy fuel, you pay fuel duty, and the government then charges VAT on top of that duty, taxing the tax itself. If you save up to buy a house, you pay stamp duty. If you sell an investment, you pay capital gains. And finally, when you die, inheritance tax can take another 40% of what's left, money that has already been taxed at every stage of your life. Over a lifetime, the government can claim up to 90 pence of every pound you earned through a salary. The ultra-wealthy avoid this decay because they simply do not participate in the standard income model. To stop this friction from dissolving your wealth, you have to stop thinking in terms of income and start thinking in terms of assets. The wealthiest business owners often pay themselves a salary of exactly £12,570. That is the personal allowance threshold. By keeping their official income at this level, they pay zero income tax, even while their companies generate millions. This leads to step 1, buy. Instead of taking cash out of the business as a taxable dividend, they use that capital, or the bank's money, to buy assets that increase in value, like real estate or stocks. This shift is the foundation of wealth. You aren't trading hours for a paycheck that gets sliced in half. You are holding property that grows while you do nothing. Most people think the way to get rich is to buy low and sell high. But the moment you sell, you trigger capital gains tax, which can take up to 40% of your profit. The wealthy use step 2, borrow. Instead of selling the asset to get cash, they refinance it. They take out a loan against the new, higher value of the asset. This is the legal mechanic making the strategy work. Debt is not income. When you borrow £100,000 against a property, you pay zero income tax and zero capital gains on that cash. It is technically a liability, not a gain. Elon Musk used this exact method to buy Twitter. He didn't sell his Tesla shares and pay a massive tax bill. He took out billion-dollar loans secured against his stock. Jeff Bezos followed the same blueprint for years. His wealth was held in Amazon shares, and when he needed liquidity, he borrowed against them rather than selling and triggering taxes. Even Adele used a mortgage to buy a £50 million home. When you are that wealthy, paying a small percentage in interest is much cheaper than selling assets and losing 20 to 40% of your money to the taxman. Using debt to access cash is the ultimate legal loophole. It turns illiquid growth into untaxed spending power. Finally, we reach step 3, die. The goal is to hold these assets and the debt attached to them until the very end. When assets pass to heirs, the debt attached to them reduces the taxable value of the estate. By using trusts and business relief, the remaining inheritance tax can often be minimized or removed entirely. This completes the cycle. You spend your life using untaxed borrowed money, and you pass the assets on without the state taking a final cut. The UK tax system is not broken. It is doing exactly what it was built to do. It was designed to tax labor and salaries with high efficiency, while leaving wealth and capital largely untouched. To escape this, you must change your financial filter. Every decision should be weighed by whether it pays you once as income or builds an asset that will compound over time. You also need to distinguish between debt that drains you and debt that builds wealth. Credit cards are a liability. A mortgage on an appreciating asset that a tenant pays for is a tool. For business owners, the difference between an average accountant and a specialist tax planner can be tens of thousands of pounds a year. The people at the top pay for experts who understand these extraction strategies. This isn't about dodging taxes. We all benefit from the NHS and our schools. It is simply about using the rules as they are written to ensure you don't pay more than you are legally required to. Financial freedom comes when you stop thinking like a salaried employee and start acting like an owner of assets. If you understand how the wealthy play the game, you can finally stop losing it.